Brace yourself. Inflation driven by tariffs is not a thing of the past. It's on the horizon, and poised to impact consumers more sharply than many realize. While Goldman Sachs has taken heavy criticism, including from former President Donald Trump himself, for forecasting that tariff-related inflation will rise, numerous economists across Wall Street share this viewpoint. The recent Consumer Price Index, CPI report, might have appeared fairly calm on the surface. But experts warn the true inflationary storm caused by tariffs is still gathering strength. The reason? Pre-tariff inventories that had been cushioning prices are finally depleting. At the same time, tariff rates themselves have climbed significantly, from roughly 3% at the start of the year to an estimated effective rate near 18% today. Companies, which initially absorbed much of these higher costs, are increasingly passing them on to shoppers. This means that consumers are likely to feel the pinch more acutely as the year progresses. Michael Feroli, chief U.S. economist at JPMorgan Chase, explains the stakes clearly. Tariffs could potentially reduce GDP growth by about 1% and add between 1% to 1.5% to inflation, with some of these effects already visible. However, he emphasizes the historical uniqueness of this situation. The scale of tariff hikes this year far exceeds anything experienced in the post-World War II United States, making the precise consumer price impact difficult to predict. President Trump openly criticized Goldman Sachs for their analysis predicting increased tariff burdens on consumers. In a pointed comment on Truth Social, he suggested the firm's CEO, David Solomon, should fire the economists responsible or even consider stepping down himself. Yet, if we were to dismiss every economist aligned with this perspective, Wall Street would be littered with empty desks. Many respected institutions support this view. Looking ahead, economists generally anticipate a slow but steady rise in prices. UBS senior economist Brian Rose notes that the prior downward trajectory for core inflation appears to have faltered, with tariffs now filtering into retail prices. He expects inflation's upward creep to continue gradually, driven by business pass-through of higher costs. However, mitigations such as slowing inflation in the housing sector and resistance from consumers feeling financially stretched could help temper the tariff impact. It's important to clarify that none of the experts foresee runaway inflation. Rather, they predict monthly inflation growth to hover between 0.3% and 0.5%. This level is enough to push the Federal Reserve's preferred core inflation measure into the low to mid 3% range. Interestingly, many believe that even with inflation picking up, the Federal Reserve will move forward with plans to cut interest rates before the year ends, having remained mostly on the sidelines throughout 2025. The expectation is that a slowing labor market and the belief that this inflation surge is temporary will create conditions favorable for easing monetary policy. Still, there's a catch in the near term. Rising inflation could dampen consumer spending and slow economic growth during the remainder of the year. Since consumer spending accounts for about 2/3 of GDP, JPMorgan projects this drag on growth to be just under 1%. The Blue Chip Economic Indicators report for August paints a somewhat cautious yet modestly optimistic picture, predicting GDP will grow at about 0.85% in the second half of the year, an improvement over the 0.75% forecast from July. This uptick partly stems from forecasters adjusting their outlooks based on the belief that tariff-related constraints on the economy are likely temporary, with substantially better growth anticipated in 2026. However, certain immediate concerns loom. For example, on August 29th, the temporary suspension allowing goods valued under $800 to enter the U.S. duty-free, known as the de minimis tariff exception, expires. This change could particularly affect retail goods, likely leading to higher prices on everyday items. Pantheon Macroeconomics predicts core inflation could jump by a full percentage point, reaching 3.5% by year-end. They highlight that only about 1/4 of this inflationary pressure has hit consumers so far, suggesting a stronger surge in core goods prices in the coming months. Adding to the complexity, BNP Paribas points out that price increases are not confined to goods alone. Recent surveys indicate service sector input costs are also rising, which could push overall inflation higher. The firm notes a nuanced worry for the Federal Reserve. It's not just about the level of inflation, but about whether prices become sticky, meaning they don't easily fall back once raised. The July CPI report showed surprisingly strong core services inflation, a sign that increasing prices might be more persistent than some hope. Understanding inflation stickiness is critical. The Cleveland Fed's measure for sticky price inflation, including rents, dining out, household items, and insurance, has steadily climbed, reaching 3.8% on a 3-month annualized basis, the highest since May 2024. Meanwhile, flexible price items like food, energy, and car parts remain relatively lower. This discrepancy suggests some inflation categories may be harder to reverse. Gus Fosher, PNC's chief economist, summarizes the situation concisely. Tariffs are set to push inflation higher in the months ahead, with July's core CPI already ticking up and the likelihood that businesses will continue passing tariff costs on to consumers. Core personal consumption expenditures, PCE inflation, the Fed's preferred inflation gauge, is expected to exceed the central bank's target even more. Here lies the controversial part. Although many on Wall Street foresee rate cuts as inevitable, the persistence of higher inflation might complicate policymakers' decisions, making them hesitant to act quickly, even if the labor market weakens further. So, what do you think? Will the Federal Reserve stay the course toward cutting rates despite this inflation pressure? Or could tariff-driven price hikes force a rethink of monetary policy? Is the focus on temporary inflation optimistic or dangerously naive? Share your thoughts below. This debate is far from settled.